Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Thanks for having me back. There's definitely a lot to cover today.
There really is. I mean, for the last decade, we've basically been trained that, when the stock market drops, you just blindly buy the dip.
Right, the classic buy the dip mentality.
Exactly. We've been taught that the central banks will always swoop in to save the day and lower rates. But what happens when that safety net completely disappears?
That is the million-dollar question right now.
It is. So today we are on a mission to build a proper investment strategy for the everyday American investor right now. Because the backdrop you're dealing with is just incredibly intense.
It's a very high anxiety environment for sure.
Yeah, I mean, the market is shaking. We've got oil blasting past $100 a barrel due to these ongoing conflicts in the Middle East. And, global stocks have been sliding backward for 3 straight weeks.
Yeah, when you log into your brokerage app and just see this sea of red day after day, your natural human instinct is to freeze.
Oh, totally. Or panic sell everything.
Right, which is worse. But that's exactly why we need to take a step back today. We cannot rely on gut feelings right now.
No, definitely not.
We need to look at the underlying mechanics of what is actually driving these massive market shifts.
I completely agree. And to do that, we are relying on some really heavy-hitting data for this deep dive.
We have some fascinating numbers to go through.
We do. So according to recent analysis from Reuters, Bank of America, and Goldman Sachs, the market is undergoing this massive psychological shift. Think back to just a few months ago.
Everyone was waiting for the Federal Reserve to announce interest rate cuts.
Exactly. Everyone wanted cheaper money. But based on the current data, the market is no longer expecting those cuts.
No, the sentiment has completely flipped.
Yeah, in fact, they're actually pricing in the very real possibility of potential rate hikes if these high oil prices stick around. So, okay, let's unpack this.
Let's do it.
Because to survive this market shakeup, we first need to understand what the market is actually rewarding right now, instead of just staring blankly at falling stock tickers.
That is the crucial starting point. You really have to realize that the stock market is essentially a giant weighing machine, right? And right now, the weights have completely changed.
How so? What's different for the everyday guy looking at his portfolio?
Well, we've transitioned out of an era where investors rewarded compelling stories or flashy tech promises, visions of the distant future.
The hype era.
Exactly. The hype era is over. We are now firmly in an era where the market only cares about cold, hard cash today.
Okay, let's make this real for the beginner investor out there. Because I used to think of this as like buying a sturdy umbrella in a hurricane. But let's look at it through a better lens.
I like analogies. Go for it.
It's like evaluating businesses on a highway.
Right.
In a booming, easy money economy, investors love funding the flashy roadside attraction.
Like a giant neon sign.
Yeah, a neon sign promising this futuristic theme park that might open 5 years from now.
Right, because money is cheap and people want to dream big.
Exactly. But when an economic hurricane hits, nobody cares about the theme park anymore. Investors want to own the toll booth on the only bridge into town.
That is a perfect way to look at it, the toll booth.
Because no matter how bad the weather gets or how high gas prices go, people still have to cross that bridge to get to work. Right. The toll booth collects cash every single day.
That toll booth analogy captures the exact mechanism at play here.
So what's the hurricane in this scenario?
The hurricane is sticky inflation and high interest rates.
The two things everyone hates right now.
Exactly. And the market is aggressively rotating out of those speculative roadside attractions and moving real capital into the toll booths.
Meaning businesses with actual cash flow.
Right. We're talking about businesses with strong immediate cash flow and real pricing power. And let me give you some hard numbers to show you just how dramatic this shift really is.
Lay it on me.
Based on the latest data, in March alone, global energy funds saw $2.1 billion in inflows.
Wait, hold on. $2.1 billion in a single month.
In 1 month. That is nearing a 12-year high for a single month.
Just pouring straight into the energy sector? That's insane.
Yes. Institutional money is rushing toward physical reality. They want things that are real. And the results are stark.
I bet.
Yeah, the top 25 global energy companies have seen their market capitalization, so their total calculated value grow by about 20% just this year.
Wow.
And according to the data, the MSCI World Energy Index is up 29.5% year to date.
Almost 30%.
Right. Meanwhile, the broader MSCI World Index, which tracks a little bit of everything across the global economy,
Yep.
that's actually down 1%.
Okay, so the broader global market is actually shrinking, but the toll booth companies, the energy sector, are growing by nearly 30%.
Precisely.
For you listening, this takeaway is absolutely vital. Don't just go out and buy a tech stock or like a clothing company simply because its stock price dropped $5.
Right. Cheap doesn't mean good.
Exactly. A lower price doesn't mean it's a good deal if the business itself can't survive this inflationary storm.
Hmm.
You have to look for businesses that can defend their profit margins.
And that concept of defending margins is everything right now.
Break that down a bit. What does that actually look like?
It comes down to pricing power. Pricing power means that if a company's raw material costs go up, let's say because oil is at $100 a barrel and shipping costs skyrocket, they can smoothly raise the prices of their products.
And their customers will still buy from them.
Exactly. They don't lose their customer base. But if they can't raise prices without losing customers, they have to absorb those extra costs themselves.
Which means their profits just vanish.
Right. Their profit margins get crushed and their stock price will inevitably collapse.
Which brings us to the actual mechanics of buying into the market. Because if we know we need to target these sturdy, cash-generating companies, how do we step in without feeling like we're trying to catch a falling knife?
That's the scariest part for a lot of people.
It really is. Because looking at the data, the S&P 500 has pulled back over 5% from its January peak. And for an everyday investor, you see a 5% drop across the entire U.S. economy, and that feels genuinely scary.
It's natural to feel uneasy. I mean, it's your hard-earned money. But let's put that 5% into historical context.
Okay, let's look at the history.
Based on long-term data going back to 1957, a 5% drop from a market peak has happened 60 times.
60 times since 57. So it's not some rare black swan event.
Not at all. It is a completely normal, regular feature of the stock market. Institutional investors constantly rebalance their portfolios, they take profits, they shift assets around.
Sure.
But here is the critical part to remember. Out of the 60 historical occurrences, only 22 of them actually worsened into a 10% or greater drop.
Wait, hold on. Let me make sure I'm tracking this math.
Yeah.
So historically speaking, more often than not, a 5% drop just stops right there and the market turns back around.
The math strongly leans that way, yeah. The historical data shows that usually the 1 month, 3 month, and 6 month returns after a 5% drop are actually higher than the historical average.
Oh, wow. So it's like a slingshot.
Basically. The market gets a little overheated, lets off some steam by dropping 5%, clears out the speculative excess, and then resumes its climb.
Okay, but I have to push back on that optimism just a little bit.
Fair enough.
Because we just talked about how severe the current backdrop is with oil and rates.
Yeah.
This isn't just routine profit-taking.
True. The macro environment is heavy.
Yeah. I mean, recent analysis from Goldman Sachs just warned that a severe energy supply shock could push the S&P 500 all the way down to 5,400.
Which is a significant drop.
That's a massive, painful drop from where we sit today. If the market could realistically drop that far, why shouldn't the everyday listener just pull all their money out, sit safely in cash, and just wait to buy back in at the absolute bottom?
What's fascinating here is that trying to time the absolute bottom is a game that even the most seasoned Wall Street professionals consistently lose.
Really? Even the guys with all the supercomputers?
Even them. If you sit in cash waiting for an arbitrary number like 5,400, the market might only drop to 5,500 and then rocket back up.
Leaving you behind completely.
Exactly. You miss the whole write-up. Instead of trying to guess the lowest point, you have to understand the mechanism of mispricing.
Mispricing, okay.
Yeah, you don't buy a stock just because it looks cheaper than it was last month. You calculate its intrinsic value.
Intrinsic value. Okay, let's break that down for the beginner. I think of it like evaluating a local business you might want to buy, like, say, a neighborhood laundromat.
Okay, I like this.
You don't just look at what the current owner is asking for.
Oh,
Right?
what?
You look at the actual cash it generates every month.
Right, the real numbers.
You look at how much the washing machines cost to maintain, what the electric bill is, what the water bill is. You look at the loan on the building.
all the liabilities.
Yeah. You do the math to figure out what the business is actually worth based on its real-world performance, not just the asking price.
That is a perfect translation. For a publicly traded company, calculating intrinsic value is about looking at their raw material costs, the amount of debt they are carrying.
Which is especially important now that interest rates are so high.
Exactly. Debt is expensive now. So you look at that and you look at the actual free cash they generate for every single share of stock. You build a disciplined mathematical process.
There's no guessing.
No guessing. You might decide, based on their cash flow and debt, this company is worth $100 a share.
Okay.
If the broader market panics and the stock price drops to $80, you buy. If it only drops to $95, maybe you hold off.
Because it hasn't hit your target.
Right. You pull the trigger only when the market price falls significantly below the true value you've calculated.
Process over emotion.
Exactly.
But man, we are humans, not algorithms. Human nature makes us want to panic when we see terrifying headlines.
Of course it does.
When you open the news and see billions of dollars evaporating from the market, it is incredibly difficult not to just hit the sell button and walk away.
It takes a lot of discipline.
It does. So let's look at the people who do this for a living. How are the big professionals, the institutional investors, handling this exact moment? Are they panicking?
The data tells a really interesting two-sided story here that requires a bit of digging to fully understand.
What do you mean?
Well, if you only read the surface-level headlines, you'd think the sky's falling. Recent data shows that global equity funds saw $20.3 billion exit in a single week.
Wow.
And concurrently, $32.5 billion rushed into money market funds.
Okay, for someone new to this, a money market fund is essentially a very safe, short-term holding vehicle for cash that currently pays around a 5% yield.
Right, it's basically a cash equivalent.
But still, seeing 20 billion leave stocks and 32 billion rush into safe cash, that sounds like a massive panic to me. It sounds like the big money's running for the exits.
It looks like a full retreat until we connect this to the bigger picture.
Okay, connect it for me.
When we look deeper into the data sets from Bank of America, we see a much more strategic reality.
What are they doing?
In that exact same time frame where some funds were exiting, investors concurrently put $62.2 billion into stocks and $10.2 billion into bonds while raising their overall cash reserves by $23.5 billion.
Oh, okay, that changes the narrative entirely.
Right.
So they aren't just taking all their money out of the system and stuffing it under a mattress in fear.
Not at all.
It's more like a tactical reload. They are moving things around, keeping a larger pile of cash in those yielding money market funds, specifically so they have ammunition to go shopping.
Exactly. They want dry powder.
Right, dry powder to go shopping when those toll booth companies hit their intrinsic value targets.
Precisely. They are acting with extreme calculated discipline. And the takeaway for you listening is that you need to act like the big money. Don't make all or nothing decisions. The biggest mistake a beginner makes is thinking they have to be 100% invested in the stock market or 100% sitting in cash.
It's not a binary switch.
No, it's a dial. Set rigid rules, keep a healthy, comfortable amount of cash on the sidelines, and buy assets in tranches.
Okay, let's define tranches for the listener, because it essentially just means buying in smaller portions over time instead of going all in at once.
Right.
So if you have, say, $1,000 you want to invest in a fantastic company, you don't drop the whole 1,000 on a Tuesday morning.
Definitely not.
You buy $200 worth today. If the price drops more next week due to some scary headline, you use your cash reserves to buy another $200 worth at that new lower price.
Yes, that's called scaling in. You do it mechanically when the prices hit your specific targets.
I love that.
Doing this completely removes the emotional weight of trying to be perfectly right on day one.
Because if the stock goes up, you're happy because you own some.
Exactly. And if the stock goes down, you're happy because you have cash ready to buy more at a discount.
That is a great psychological trick. It turns a market drop from a source of anxiety into an actual opportunity.
It really does change your whole mindset.
But I want to pivot to a different scenario really quick.
Sure.
What if the market doesn't crash all the way down to 5,400, but it also doesn't bounce right back up? Like, what if it just gets stuck?
That is a very real possibility right now.
Because right now, there is a serious convergence of major risks. We've got the blockade in the Strait of Hormuz disrupting global shipping.
Which drives up costs.
Right. We've got rising oil prices, the reality of interest rates staying high, and this looming, terrifying fear of stagflation.
Stagflation is a central bank's absolute worst nightmare.
For those unfamiliar, let's explain it. Stagflation is what happened in the 1970s.
It's brutal.
It's an economic condition where economic growth halts, it stagnates, but prices for everyday goods continue to rise.
Right. Inflation stays hot while the economy freezes.
And it's a nightmare because central banks really only have one major tool, which is interest rates.
Exactly. If they raise rates to fight the rising prices, they crush whatever little economic growth is left.
But if they lower rates to stimulate growth, they cause prices to just explode even higher.
You're completely crapped.
You're trapped. And to add to that convergence of risks, the central banks might not be able to come to the rescue at all this time.
That's what the data is suggesting.
Yeah, recent data looking at Federal Reserve futures for late 2026 actually show a higher probability of rate hikes than rate cuts.
Which shocks a lot of people.
It does. And over in Europe, the European Central Bank is absolutely terrified of something called secondary inflation caused by these energy shocks.
Yes, secondary inflation is essentially a wage price spiral.
How does that work?
So oil prices go up, right? So it costs more to transport food, making groceries expensive.
Everyone feels that at the supermarket.
Right. Workers then demand higher wages to pay for those more expensive groceries. To afford paying those higher wages, companies have to raise the prices of their goods even more.
And it just feeds itself.
Once that cycle starts, it is incredibly difficult to stop, which is exactly why the European Central Bank is so hesitant to lower interest rates to help out their stock markets.
And there's a huge global divide happening right now in how different countries are handling this.
A massive divide, yes.
Now, looking at the geopolitical context from our data, we have to note that with President Trump currently in office, there has been a specific policy focus on domestic energy production and keeping American supply chains insulated.
That's right.
And just to be absolutely clear for you listening, we aren't taking any political sides or endorsing any administration's policies here. We are strictly reporting the economic analysis contained in our data sources.
Of course.
But from a purely economic standpoint, this focus means the U.S. domestic market and the U.S. energy sector are relatively protected from some of these global shocks.
That's a crucial structural distinction. The U.S. is a massive producer of its own energy, which naturally creates a buffer.
Right.
Conversely, recent analysis highlights that Europe and Asia are highly vulnerable to these exact energy shocks because they rely so heavily on importing their power.
They don't have that domestic buffer.
Exactly. And then you look at China, which historically drives a massive portion of global growth. They are facing severe deflationary pressures right now.
Which is the opposite problem.
Right. Their property sector is struggling, and they are flirting with what economists call bad inflation or debt deflation.
Bad inflation, what's that?
It's where the prices of goods drop, but the value of their massive debts does not. So it makes those debts increasingly impossible to pay off.
Man. So if Europe is dealing with a wage price spiral, China is dealing with a debt crisis, and the U.S. is just trying to hold the line with high interest rates.
It's a complicated board.
It is. The market might just move sideways. Like it might just bounce around in a big, flat, frustrating box for months and months as we wait for these political and energy risks to sort themselves out.
Sideways markets are very common in these transition periods.
But to an everyday investor, that sounds agonizing. You're telling me I might invest my hard-earned money today, and a year from now, the market might be exactly where it started.
It's entirely possible.
How do you even make money in a flat market?
This brings us to one of the most misunderstood concepts in investing. A sideways, boring market is actually a secret gold mine for prepared, patient investors.
Okay, a gold mine. Break that down for me. If the stock price isn't going up, where's the value actually coming from?
It comes back to the intrinsic value we discussed earlier. Think about the underlying businesses themselves.
Okay.
Let's say the overall stock market index stays completely flat for 2 whole years.
It's a straight line.
Right. During those 2 years, a well-run, sturdy company, our tool booth, is still operating. They are still collecting cash. They are still making profits. They are still using those profits to pay down their debt or buy back their own stock.
Oh, I see.
So their actual mathematical business value is growing stronger every single quarter. Over time, the gap between the company's stagnant, flat stock price and its constantly growing intrinsic value gets wider and wider.
Oh, wow. I see it now. It's like someone going to the gym every single day wearing a huge, bulky winter coat.
I love that.
Right. To the outside observer, they look exactly the same for 2 years. But underneath the coat, they are building serious muscle.
Exactly. The stock price is sleeping, but the business is working out.
So eventually, the market has to wake up, take the coat off, and realize, wait a minute, this company is fundamentally vastly stronger and making way more money than it was 2 years ago.
Yes.
And then the stock price will eventually shoot up to match that new reality.
That is a brilliant way to visualize it. It creates massive mispricing opportunities. A sideways market allows you to quietly, steadily accumulate shares of fantastic growing businesses at flat discounted prices.
You're just stacking up value.
Exactly. It requires a lot of discipline, but the eventual payout is incredibly rewarding.
Okay, but let's be entirely realistic for a second here.
Okay.
Calculating intrinsic value, analyzing corporate debt structures, monitoring European wage price spirals, and tracking global supply chains.
It's a lot.
It is an immense amount of work.
It's a full-time job.
Most of our listeners are everyday Americans with full-time jobs, families, and busy lives. They want to safely grow their wealth and protect their purchasing power without making Wall Street analysis their second career.
Understandable.
So what is the absolute smartest, most reliable, mechanical move for the beginner who just wants to survive this storm and come out richer on the other side?
Well, the absolute smartest move is fortunately also the simplest.
Good. We like simple.
Despite all the fear, stagflation headlines, and the energy shocks, the data shows that $47.1 billion still flowed steadily into U.S. equities recently.
People are still investing.
They are. And the best way for an everyday investor to participate in that wealth creation is through systematic investing in broad, low-cost ETFs or exchange-traded funds,
Okay.
specifically using the practice of dollar-cost averaging.
Let's explain dollar cost averaging mechanically for everyone.
Sure.
Basically, it means taking the exact same predetermined amount of money, let's say $200 from every single paycheck, and buying a broad U.S. market ETF completely regardless of what the news says.
You don't even look at the news.
You buy when oil is at $60, and you buy when it's at $100. You buy when the market is at an all-time high, and you buy when it drops 5%.
It's totally automatic.
Yeah, it's like putting your retirement savings on cruise control. Even if the road is incredibly bumpy and terrifying right now, the vehicle just keeps moving forward at a steady, emotionless pace.
That mechanical, emotionless approach is its greatest strength.
Really?
Yeah, the data strongly emphasizes that the best defense against unpredictable energy markets, interest rate surprises, and political shocks is that steady rhythm.
Because it takes the human error out of it.
Exactly. Think about the math here. When the market drops 5%, your $200 automatically buys more shares because they are on sale.
Right.
When the market recovers, you now have more shares participating in that growth. It completely removes the human urge to panic sell at the bottom or greedily buy at the top.
So the actionable takeaway for the listener here is to let low-cost ETFs be the unbreakable core of your portfolio.
Your foundation.
Exactly. That's your concrete foundation. Set it, automate it, and literally forget it. Then, if you have extra cash on the sidelines and you want to be a bit more active, use that extra cash to selectively buy tranches of those individual, sturdy, cash-flowing toll booth companies we talked about earlier.
Let those be your satellite investments.
Yeah. Because in a market where forecasting the future is practically impossible, having a sturdy, reliable, automated structure will always beat trying to predict what the Federal Reserve or the global oil markets are going to do next Tuesday.
Exactly right. A successful long-term strategy survives because of its rigid structure, not because of a lucky prediction.
So true. So let's tie all of these threads together as we wrap up.
Let's do it.
Today, we set out to build a proper investment strategy for an incredibly complex, high-interest environment. We learned that you need to prioritize real, cash-generating toll booth businesses over flashy, speculative hype.
Yep.
We learned that you need to rely on the cold math of intrinsic value instead of the fear generated by the daily headlines.
Process over emotion.
We discussed how you shouldn't fear a boring, sideways market because it's actually a hidden opportunity to buy growing companies at flat prices.
A winter coat at the gym.
Exactly. And most importantly, keep your low-cost ETF cruise control turned on at all times, no matter what the news cycle says.
It is a solid, incredibly resilient framework for the everyday investor.
I think so, too.
But I want to leave everyone with a final, completely different thought to chew on regarding the future.
Yes. Hit us.
We spent a lot of time today talking about the shift from digital promises to physical realities like energy and raw materials.
Right. The toll booths.
If we are truly entering a prolonged era defined by physical constraints, where access to power, copper, and land becomes the ultimate bottleneck for global growth, how much of your long-term portfolio is currently built on digital tech companies that absolutely rely on an endless, cheap abundance of those physical resources to survive?
Wow. That is a fantastic and, honestly, deeply unsettling question.
Something to think about.
Definitely. If the physical world gets expensive, the digital world might suddenly find itself struggling to pay the toll. So take a hard look at your portfolio and figure out if you own the roadside attraction or the toll booth itself. Don't forget to subscribe and hit that like button.